So the capital markets, as most of you know, I mean, this is really the kind of fastest moving and I would say most kind of creative source in ship finance. And we're very lucky to have this group with us today who are involved with a lot of transactions. And actually, the last month has been an extremely busy period in the capital markets for shipping. So looking forward to sort of catching up on what's happened and what these guys think is going to happen in the months to come. Steve, thank you very much.
Hey everybody. It's an interesting time to be here. I mean, getting the band back together is certainly something that is very appropriate, especially for the conference, but also for this panel. I would say it's been many years since we have been having capital markets panels, and this will be an interesting one. I'm Steve Hollander, partner at Watson Farley Williams, and I have a list of everybody's names, but really just because I happen to have their titles. We got. Let's see here, in order. Marius Halverson, Head of Investment Banking at Arctic. Chris Wires, MD and Head of Maritime Investment Banking at Stifel. Doug Mavernack, Global Head of Maritime Investment at Jefferies. And Larry Glassberg, Partner and Senior Managing Director of Investment Banking at Maxim. I think this is, as I said, this is a really interesting time, and I think it's, I guess, the most important question, and the biggest one is, is capital markets reopened for shipping? And I'll leave that generically if anybody wants to jump in, or I'll start picking on people. No?
Pick on Larry.
Pick on Larry. Well, everybody does. Okay, Larry, have you done any capital markets deals in the last few years? Perhaps.
That's a little bit of a loaded question. First and foremost, good to see everyone, and it's glad to be back in front of people. As a New Yorker, seeing our city come back to life, it's amazing. As it relates to capital markets, listen, we've been fortunate at the Maxim side that we've been very active from a maritime point of view in the last 2 years, in particular the last 5 years. We've done about 35 equity deals over the last 2-year periods. I would say one of the major things that are driving equity markets today is volatility and liquidity in the underlying stocks for a lot of maritime names. I think those names that have more liquidity are what's driving dollars coming into stories. I think we've seen valuations all over the map in terms of where we've been able to value companies. We've raised capital at 4 to 5 times NAV, and we've raised capital below NAV. And I think a lot of that is going to be predicated on capital structure of those businesses, where that business is at the time of their life cycle, and are you able to get into the market very quickly and be very quick to react to an uptick in the stock price if there is the opportunity to leverage that. So, I think the next year is going to be very volatile. We are actively looking at IPOs for the market. I wouldn't say we're looking at large cap IPOs. I think there's levels of the market, and what we do may be very different than a Citibank or a Morgan Stanley. And we're fulfilling the needs of our clients and what our customers are asking for from an issuer point of view as well from an investment point of view.
So I'll go down
If you want, that's fine.
Sure, yeah. So to your question, it's been a busy year. At Jefferies, we've done 7 or 8 capital markets transactions this year. Spanned the groups of the liners, the containers, the bulkers. And what was nice about how the year unfolded was that each of those deals worked. And so it wasn't like you're trying to get through 2 or 3 transactions and you prefer the window closing. And this was the first deal worked. And then you call the same group of investors that participated, made some money. Hey, we have another one. And then that one worked. And so it was kind of a success, you got success type of a situation. So the markets were very wide open, and I would argue that they're still somewhat open depending upon the sector. I mean, if you're a container ship owner, and it's not like any secret sauce, but look at how the stocks are trading. I mean, if you're talking about a group that's trading at 70, 80% of a net asset value, not only does it mean that if you're going to do a transaction, it's going to be a discount to that, but it's just also indicative of the fact that there's just not a lot of investor interest at that point in that particular sector, that particular name. But if you look at the container space right now, those names are still doing quite well. And so, the conundrum is usually whenever your stock is doing well, you're generating a lot of cash. You don't necessarily need to access the capital markets. So it's one of those types of situations. But yeah, I mean, it's been a phenomenal year from a capital raising standpoint. And the window remains open for the right industries and right names.
I'd say, at Stifel, I more or less agree with what Doug has said. It's been a super busy year for us as well. The capital markets has been, across the firm, incredibly busy. Across Maritime has been pretty busy. I think Maritime companies have access to more forms and sources of capital today than ever before. And we continue to see kind of new competition showing up in the market. A couple years ago, we were doing a lot of, kind of $25 par prefs and baby bonds. Now you've seen two of those issuers go to Greece and raise, senior notes at, a fraction of the rate that, it costs to raise the capital in the U.S. market. We've seen the Norwegian bond market, do quite strongly as well. We've been active in the U.S. We've been really active on, I'd say, more of the private side than the public side. The challenge with public capital raising in the U.S., I'm sure we've all seen in this room, is companies have a lot of cash and their share prices trade at levels, where they don't really want to sell stock. They're better paying dividends and buying back shares. But we've seen, I think, more kind of long-term investors, the likes of Fidelity's and Wellington's, coming into shipping over the last, kind of 4 to 6 quarters, and we've seen, over the last 10 years. So I think it bodes well for, for the ability of companies to raise capital and grow their businesses going forward.
Yeah, I'm not sure if there's that much to add, but
non-US thoughts.
No, I think on the question, are the markets open? Obviously, yes. As long as ship have value and the stock exchange is open, the market will be open. The question is, why would you want to exit it if assets or the companies trade the way they do? When you look at Arctic, what we have done to get, great colleagues here, we've been very active as well. And what I think is really interesting is how broad the product spectrum of how we've been active. The start of the year, we did a large number of equity issues, particularly in the dry cargo sector. Then we did a number of sale-leasebacks. We have done bonds both for dry cargo companies and for tanker companies. And we have done public to private transactions. We've seen a number of them in the LNG space, and of course we advised KKR on the acquisition of Ocean Yield. So we've been very busy. We've been participating in 2 IPOs, Himalaya and in Western Bulk. We had 2 IPOs coming up still at the moment. One was Graham Car Carriers. That wasn't priced correctly, so they are sort of back at the drawing board. And you had the Höegh family trying to raise money again for their car carriers. So they haven't come to the market yet, so we don't know how they're going to do. But definitely, there's a lot of activity. But of course, as we have seen now on the dry cargo side, prices have come up the way they are. So then it comes down to more why would the access it when they're making as much money as they do, and trading as low as they do.
And if I could just add one thing, not to belabor the point, but Mary's brought up a great point. I mean, you have the Graham Car Carriers going public in Oslo. You had Zim, a liner company listed in the US. That's never been done before. We had a dry bulk company that we listed in the UK as an investment trust that listed at net asset value. So there's been a lot of unique things, which is indicative of just how strong the market can be.
So I'm going to pick on Larry just because you mentioned that you're working on some IPOs. What's your top tip for a private family-owned, let's say, ship-owning company that's looking to go public? What do they think they need to do in order to get themselves ready to prepare themselves?
Well, I think in this type of market, it's speed, right? And I think what we're, I think probably my colleagues would probably agree with this, is that the maritime industry in particular, the public markets, the window opens and closes very quickly. A lot of commodity-driven or cyclical industries, you typically are getting public when the market's performing well. And traditionally, when NAV is significantly above NAV from a public comms point of view. I think from a process point of view, when you're going out to do an IPO, yes, there's a huge amount of budgeting and time and transitioning if you're a family-owned business versus a institutionalized business, and you have to do it in an effective way. One, to manage costs through the IPO, through the IPO process. But I think ultimately, transparency in terms of the company, trying to remove as many related party dynamics in a transaction as possible, are going to be critical to get out. And I think ultimately the goal is to get out and get out at a valuation that you feel comfortable with, right? I think sizing of deals are all relative to the size of the company that's coming out. But I think what you're seeing today and in the public markets is that a lot of companies are not necessarily trading at their true values, right? There's a lot of irrationality that's happening, especially in some of the smaller names within the maritime industry. So, I think ultimately the things that we're giving as a last takeaway is speed. If you're going to do it, you're going to do it very quickly right now, because there could be a window in the next 6 to 12 months to get out.
Interesting. Doug, you mentioned that obviously a lot, there's no secret here that there's a lot of companies right now that are public that are, we'll say, awash with cash. What capital markets activity, if any, should they be doing?
Quite honestly, I don't know that they should be doing much. There was a debate earlier today about do you pay down debt or.
I heard people taking over our turf and just trying to talk about the capital markets.
Right, yeah.
Other panels, we'll have separate discussions with them over drinks.
Yeah, so but not to pick sides per se in that previous debate. However, there's a lot of market precedents that would suggest that, a lower debt type of a model does achieve a better valuation. For example, the dry bulk company that I referenced that we took public back in April in the UK, no debt model, priced at net asset value. It's probably the best trading dry bulk listed entity that there is. So there is a lot of merit to that type of a model. And so, whenever the tanker market was ripping in the middle of the pandemic because of floating storage and things like that, our advice was pay down debt. Don't be, juicing your dividend just to, enhance your returns in the near term. Pay down debt. So if I'm flush with cash and I don't need to raise money, I don't know that I would. I would, even though it goes against what our job is. I think that that's the most prudent decision.
Chris is making a face, so I think.
Yeah, I'll just make a comment that I know everybody's heard before, but to me, it's the way everybody should think about it. You got to look at your share price. If you've got cash on hand, and is it share trading at a good value or is it not? For a lot of commodity companies, you look at that asset value. There's other ways to look at value as well. But if you're happy with your value, then you should look at investing in more assets with your cash. If you're not happy with your value, you got to get the cash back to the shareholders. You can do that by paying down debt. You can do that through dividends. You can do that through buybacks. If you look at the companies that are valued, at higher levels relative to their asset value in the public markets, most of them pay dividends or do buybacks and regularly distribute cash to shareholders. The ones that tend to be valued at the big discounts, tend not to do that. I think there's a very strong correlation, and that's pretty clear, what investors want these companies to do.
I guess turning a little bit, there's been a lot of discussion, including at my firm, in terms of ESG sustainability, and people putting out publications like my firm did on the sustainability imperative. But in it, for example, we found that 45% of respondents said that they were most likely to use a share issuance to fund innovation or require technology. Do you think that there's going to be money for ESG innovation, ESG needs of public companies, or does a company have a better chance of finding investors if they're using it for an ESG purpose? Or do you think that's all just kind of window dressing and companies are just going to raise money based on their NAV and based on their specs?
No, I don't think it's window dressing. At the end of the day, shipping companies make their money from doing shipping services. So, the ESG aspect here is related to either regulation or technology. The technology they buy from third-party vendors, they really develop it themselves, and there's a huge market for those who develop, whether that is hydrogen or scrubbers or ammonia, what it might be. There's definitely a lot of funds available for development of that technology. For shipping companies to access that through funding is straightforward. We see no problem for shipping companies to fund themselves for that.
I would say from my perspective, we're in the market right now with transactions that are broadly kind of oil related, and we're in the market with one that's very clearly renewable related. There are a lot of investors today that just won't touch oil. They won't touch kind of, anything that, isn't viewed as, carbon, neutral or carbon negative. And I can say in my career as a banker, which, is 20+ years, I've never seen that until this year. You heard about it in Europe. I know it's been talked about in these conferences for a while, but I see it on every deal I work on. Every fund wants to show that they're investing, in ESG friendly ways, and as it relates to our sector, it's really the E. It's the energy and the carbon. I know we don't really have answers for how we're really going to do major carbon reductions, but investors want to see it, and they're really only investing in deals right now where companies are making commitments to move forward with that.
One thing I would add is sitting in on a lot of these meetings of the transactions I was talking about earlier. Every single conversation involves some sort of aspect of ESG. So it is critical to some of these investment decisions.
Yeah. So on the topic of ESG, really, and I think, Chris, you hit the nail on the head by saying a lot of people are focusing on the E of ESG. NASDAQ, as most people here know, recently passed a diversity requirement for public companies, saying that the boards now have to be diverse. Are there any tips for public companies, for people who want to enter into or already in the capital markets, on the social or governance aspects to make themselves more attractive to investors? Or is, again, that something that just you have to follow the NASDAQ rules and follow that?
Diversity regulations on NASDAQ?
Yeah.
Yeah, I mean, also stock exchange has had that for years now. It works perfectly fine. I'm amazed we have this conversation in 2021.
I think the issue, the U.S. markets are very much a disclosure-based market. As long as you tell everybody what you're doing, everything is okay, or is maybe not okay, but we'll say copacetic. So the concept that NASDAQ is passing is one that the New York Stock Exchange doesn't have yet. So I think it's going to be an interesting development to see how companies react and whether they're going to, follow what NASDAQ wants them to do, or just disclose as to the reasons why they don't, because that is always an option that NASDAQ companies can do. But it was more curiosity as to whether you're seeing investors care, whether investors are going to turn and say, well, this board is diverse, this board doesn't have this.
I can tell you that companies care. Like the companies we speak to care. They ask us for recommendations of board members, with the goal of adding diversity to their boards, all the time. And as part of our committee process at our bank, we have to talk about ESG with every single company, and it's not just the E. It's all aspects. I haven't seen it in my discussions with investors. No investors told me they're not going to invest in something because of the S or the G, only the E at this point. But anyway, everybody's focused on it, and I'm sure if they felt the company wasn't, S and G friendly, they would, they certainly would take a pass.
I guess maybe this one just for Larry, because you've been quiet for a bit. Throw over the bus. What M&A activity are you seeing for companies that are already public?
I would say it's depending on the cycle and size of the business. We are most of our time, I would say, spending our time around sub $300 million market cap companies within the maritime industry. I would say activity on the M&A side on those sides of the businesses have been historically less than as you start getting up in the size of businesses in the market. I think actively, though, is with a IPO window that's been somewhat shut over the years. I think if M&A is going to happen, especially in the lower size businesses, you have to have parties that ultimately want to come together. And I think a lot of times, especially in some of the smaller businesses where there's a very large majority owner in a lot of cases, it's tough combining a lot of businesses together in that regard, and those personalities and valuations around the market. But I think ultimately is we've historically done reverse mergers, we've historically done traditional M&A within the sector. If the markets tighten up, we may start to see some more. But I think ultimately, as long as the capital markets are open, I think we'll see more M&A activity in the next 24 months.
Yeah, and Steve, I'm glad you brought that up, because to me, 2021 was about as much about M&A as it was about capital raises. You saw a number of public-on-public transactions. You saw a number, even last week or two, of public to private transactions. And I think you're just going to see more of it. I mean, there should have been more in 2021. There will probably be more in 2022. So I would see that trend continuing.
I think we're seeing, at least on our end, we're seeing a lot of M&A kind of, and not necessarily in the international flag commodity shipping, although we're seeing it there as well. But if you look at the niche shipping markets, like in the Jones Act, in the Canadian flag, and like kind of the stuff related to shipping with the ports and the various infrastructure around the ports, and we've been extremely busy with M&A activity there. And then we've seen a huge run of go private transactions. We talked about four go private transactions this year, including Secor, which is a Jones Act company that went private with AIP. So as we see certain companies continue to trade for values that don't make realistic sense relative to the value of the underlying business, I suspect we see more go private transactions as we press ahead.
Go ahead.
Yeah, no, I can just second what Chris was saying here. I'd be very surprised if we don't see more public to private transactions based on how things are priced at the moment.
When we run M&A processes, even outside of traditional shipping, probably 3 times out of 4 financial buyers are willing to pay more than strategic buyers. So there's a lot of private capital out there, and it's cheap, and in a lot of cases it's cheaper than public capital.
And Steve, one thing that you might see, and I think it's really going to be driven around valuations. You might have hybrid type deals, like companies starting to go public through SPACs, because I think what might happen from a public market dynamic is if valuations are jumping up pretty quickly. There are so many SPACs out there. They may not be maritime focused SPACs, but generally speaking, SPACs have the mandate to do whatever they want to do. And if there is that big public to private arbitrage, you may start seeing these hybrid M&A transactions utilizing those vehicles to go public.
So, while we're talking on the topic of M&A, do you think, I guess M&A can be broken into different categories. You can see public company going private company, merging, going public, or 2 public companies merging. Do you think there's going to be one more than the other in the next, let's say, 12 to 24 months? Or do you think it's just companies, certain investors are awash with cash, for lack of a better term, and they're seeing shipping as a good investment suddenly?
Great.
I'll say Doug.
You'll see more public-to-public transactions. This year we had a couple. We had some go privates. We also had some public companies acquiring private fleets. I think you're probably going to see more of the same, a little bit of all, but you'll see more public-to-public transactions in 2022.
And what about deals like the Ardmore deal for, also we'll call it shipping adjacent, or shipping related M&A activity that's not necessarily a shipping company? Is that something that people are expecting, or is that something that you think we'll stick with the private market?
I think historically the market has been very skeptic to even mixed fleet companies. So I think you're going to get a better pricing by adding adjacent businesses. I think that's a non-starter. I don't see a big market for that at all.
I agree. I haven't talked to any shipping companies that are looking to invest in kind of, let's just say, to be developed technologies.
Toppy market, if that's going to happen, right? Because that basically means that people have access to unlimited capital to do this sort of things. But you are seeing today, right, spin-outs from companies. That's kind of the changing some of the conglomerates, spinning out sub-assets, and we'll see how that plays out, I think, in the next 12 to 24 months as well.
Yeah, there have been a couple spin-outs that have been publicly announced recently, and is that something that you think will bring better valuations to the investors overall?
I think time will tell, I think, on those. In the case of, Euroseas and Eurodry that spun out, almost 2 years ago, it's worked out very well for them. I think in the next couple of months with Diana's spin out, as well as with StealthGas, I think you have to see how the stops trade once they spin out. Now, I think in some of those situations, right, you're talking about much smaller spin outs versus large spin outs of either very diversified or very large fleet. And, you know, that's a little bit to the, you know, sometimes the inefficiencies in the capital markets, how some smaller companies may treat differently than much larger companies with more diversified free floats and more diversified shareholder bases.
So changing gears a little bit, because we're getting towards the end of this session. We've been talking a lot about capital markets generally, and at the beginning we were talking a little bit, mixing a little bit between equity and debt, and then we kind of focused more on equity. Do you guys think the U.S. debt capital markets is still open? Because there haven't been as much activity as there has been for equity as there have been in Norway. There's been it hasn't stopped. But,
The Norwegian market has been tremendous, and it's still wide open. Look at we were involved in the latest was Euronav, $200 million and secured at 6.25, which is a great coupon for the company. So that market is still open and frothing. But in the US, I think I'll pass it over to.
Yeah, it's a little more challenging here in terms of pricing. So, open is one thing, competitive is another. That's probably going to remain a challenge.
do you think it was mentioned, I think Chris mentioned at the beginning, there have been 2 Greek bonds done, one by Costamare, one by Capital Product. Do you see a lot that is a new market and that just companies are going to go there, or is that going to be more sporadic?
No, they broke ground. Definitely it's a new venue, and they managed to tap into it. So why shouldn't it be open for other companies? I definitely think that was really interesting how they broke ground there, and that's most likely open for other fellow Greek companies as well.
Right. Given the pricing, they should. That's a phenomenal result for both of those companies.
Yeah, time will tell, but I think, if you're giving the rates are just phenomenal, and I don't think that's something the U.S. market is able to provide. I guess what do investors want to see in public companies that they're not already being provided, if anything?
I think for shipping, investors have such a wide carte blanche of shipping companies to invest in now. It's basically everything is covered from small to large to liquid to illiquid to dividend paying to non-dividend paying. So I think there's pretty much something for everyone out there already.
I don't know if that's good or bad. I would say, do you think, I would say, Larry, you mentioned that the window for IPOs, you said, was going to be open for the next 12 to 24 months. Is that because, without holding your feet to the fire, you predict that the rates are going to stay up the way they are? Or is the reason just because you're afraid that there's a limited number of entrants to the market, and whoever the first X number in the door are going to make it, and then the market window is just going to close because of the size, the number of public companies that are out there?
I don't know if I'm giving visibility to 24 months, but I would tell you is we spend a big portion of our time in the small and micro cap market, and I would tell you is generally speaking across almost every single vertical, we're seeing deals that are getting done in the market at valuations that we're scratching our heads sometimes, right? And I think a little bit of that comes back to where the investor demand is, right? And I think what the market, from what we're seeing investors, is that there's a pretty big appetite today, especially in small cap world, for new issuance that's coming out of the market. I think next year it's going to be somewhat choppy. I think there's going to be a lot of volatility in the market. We're going to see, I think, deals potentially coming out within the U.S. as if you have a number of quarters of very good sustainable visibility on earnings growth, on cash flows and the like. And as long as valuations are starting to tick above NAV, you're going to see people coming out, right? And I think the view is if you can get out around NAV, maybe a small discount to NAV, you are going to ultimately have the ability to then grow your business in the public markets. And NAV today, we know it's moving. What it is today is going to be very different tomorrow. So it's the perceived long-term view of what you're trying to do and create with your company versus looking at a moment in time on valuation. And I think the people that have longer-term views on what they're trying to create with their business will take that risk and optionality on going out from public markets when we're assuming you need to deal with it.
Yeah, I mean, to me, that's one of the things that 2021 demonstrated was that it wasn't like 2018 whenever the dry bulk window opened for 3 weeks and there was a finite amount of demand. There was more demand for each transaction that came to the market. And so, because people had succeeded and had a nice return on the investments that they had made. So I don't think that will mark the end of however long the window may remain open. I think it'll come down to monetary policy. How long does easy monetary policy last? Fiscal stimulus, what sort of impact does that have? And so long as, the Fed is comfortable running things hot, you have inflation, you have, as a positive impact on commodity prices, commodity demand, transport demand, et cetera. So I think that'll probably be a closer thing to watch than, depending upon how much, equity gets actually through the window.
I saw in the Wall Street Journal article today that I guess Maersk made more money in the third quarter than Amazon and UPS combined. So the profits that the companies are making in the container space and the dry bulk space, and now the LNG space are astronomical. A lot of companies are putting that money to really good use. They're repaying debt. You're seeing market caps grow. There's lots of companies with market caps well in excess of $1 billion. Now that wasn't the case, pre-COVID. I think there's more of an institutionalization of shipping that's occurring. So even though people don't like their values, I think a lot of investors are starting to make a lot of money in shipping, and I think there's renewed interest. And I suspect we'll see a lot more U.S. Public market activity as we progress through next year. And I think there's more value in shipping stocks right now probably than any other sector of the U.S. stock market.
I wish that the clock was at 0 for that ending. But we have time for one more question. I think, unfortunately, that's the way the timing works sometimes. And this is more specific, but very nice. You turned the clock down to 0. I think my partners usually try to do that to me anyway. The companies that do want to give their money back to their shareholders, it's something that Chris had mentioned from earlier. One is better than the other, doing a dividend versus a buyback, or a company, if it does, either one is treated the same.
I think it depends on the strategy of the company. I think there's a bit of a preference towards dividends. Like, investors look at dividends as free money, even though the stock price normally declines by the amount of the dividend that's paid. Whereas buybacks, you only go to a select few, but I think you get effectively the same result either way.
Definitely dividend. Investors expect to be paid. The markets are good, and that's how they get paid back, in addition to the appreciation of their stock. Buybacks in general is not noticed, and it strangles the liquidity of the company, which, for most shipping companies is limited. So I would say investors are looking for dividends.
Okay, well, that's all the time we have. Thank you to our esteemed panelists. Hopefully the band is back together from a capital markets perspective, and look forward to seeing everybody at earnings.